This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Hey, this is Greg, and thank you for this week's show. Thank you for joining us. You're probably listening to last week's show, and you might have even pooped your pants a little bit because it was a little bit scary. But you're gonna be all right because this show, we're gonna offer you solutions. We're gonna offer you 2, 3. We'll see how many solutions we can get in this half hour. But what this show is really about is, have you ever asked yourself, like, who has your family's best interest at heart? Who has your best interest at heart? A lot of people don't really think about that question, and what they do is they outsource their financial responsibilities. And if that's something you're doing, then I'm a little worried for you, and I really need you to listen to Andy Tanner when he starts talking about solutions in this episode. Because a lot of people, they think that Social Security is going to take care of them. Or if you listen to the last episode, 56% of Americans think their 401k is going to take care of them. Or they're trusting financial brokers, or they're asking their Uncle Jimmy Bob for advice on oil stocks. That's outsourcing your financial responsibility, and that is not being responsible for your well-being or your family's well-being. Because what we learned last week is the danger of trusting your 401k as your retirement package. And so I'm going to bring on Andy Tanner, who is not only the Rich Dad stock advisor and the advisor to Robert and Kim Kiyosaki personally, but he also wrote a couple books, and one of them is called 401 Chaos. And we really kind of dove into that book a little bit last week where we got to hear all about the chaos. But this time, Andy's going to give you the 401k solutions. So, Andy, well, I'm excited to hear the 401k solutions.
Well, it's great to be here again. I mentioned before we went live just how much I enjoy hanging out every week and spending a little bit of time, on this financial education. So thanks for having me, and just a big congratulations for everyone listening. 401ks in the United States and even globally, RRSPs in Canada, supers in Australia, even in Tokyo, they have a 401k. They stole the name or copied it or whatever. And so this affects millions and millions and millions and millions of people. And so there's not another topic in the world of finance that is more important. So this is great.
Yeah, it's super important because it's super dangerous. And people are getting hurt and they have no idea. And most people won't realize how hurt they are until they try to retire. And by then, I'm not going to say it's too late, but their life has shifted and they're terrified, and they get woken up to this reality that hopefully last week we exposed them to so that they're not shocked. But what we didn't do the last week is tell them what they can do to fix this solution.
Sure.
To fix this problem. And really the solutions are the part I'm excited about. So I'm excited to hear what you're going to offer us, Andy.
It's interesting because problems often suggest the solution. We talked about problems last time, and often when you can identify a problem, the solution often presents itself. And I think they'll find it, everyone will find this actually quite simple. There'll be at the surface, as you delve into details, everything gets more complex in details, but we'll have some great stuff. So
can I just interrupt you real quick there?
Yeah.
Because I was so disturbed last week that I did dive into it. I was like, started looking for solutions. I don't have a 401k, but like it hurt me, the thought of these things. And so I went out and I found an app. It's called the Robinhood App, and it's free. There's no fees. So I'm like, oh, this is the solution. You can manage your own stocks and purchases and no fees, so you don't have to worry about all the 401k crap. But you were telling me a little earlier is that's not exactly right.
That's a big but. Let's begin with a bunch of, let's go problem solution. Let's just go fire away at this. So let's start with the first one that you brought up. So one of the problems with 401ks is people went to school for their job mostly. Let's say someone is a college graduate and they decided to go into, whatever their degree was, accounting, engineering, teaching, whatever it was, that's a lot of time spent learning how to work for money. And one of the problems with a 401k is there's a very large lie that says, oh, well, you don't need to learn anything about money to have money work for you. Now, you can spend $200,000 and go to medical school, $250,000 student loan to go to law school to learn medicine and law. But see, when it comes to money, just get an app on your phone, you'll be fine.
Right.
And, I don't know anyone personally who's gotten rich on Robinhood yet or any of those apps. I know people who have struggled, but let's just decide whether, the car is what is important or learning the rules of the road that is important. A car might have a wonderful safety rating, a fabulous safety rating, high safety rating. And if I let my 12-year-old son behind the wheel after giving him alcohol, two bad ideas combined, I really don't care what the safety rating of that car is. I'm nervous about him driving without understanding. So let's start with the first solution, which should be obvious, is that your wealth will be a function of your financial education and your discipline to execute a plan. Let me say that again. Your wealth will be a function of your financial education and the discipline to execute your plan. And there is not going to be a substitute. So the first lie that the 401k says is, oh yeah, just use your degree and work for money and throw a little bit in here in this 401k and things will be fine. So I recommend that you learn the 4 asset classes and understand that whether the brokerage you use, whether it be Robinhood or whoever, the brokerage that you use is not going to be the function of your success nearly to the degree that your financial education. Warren Buffett was successful before they'd invented computers. He was successful before E-Trade or Ameritrade or any of these came to be. And the same things, all the brokerages and the apps do is allow you to place trades. And it's your knowledge that will do that. So hopefully we didn't belabor that too much. But the first thing is start to study 401ks. There's books on this stuff. Start to learn about money is the first key. Now, that's a very broad idea, but if the problem is ignorance, the solution is education. So we'll checkbox that and say, okay, one of the problems of the 401k is you have people who have studied to work for money rather than have money work for them investing. That's a problem. People driving cars without a driver test and a driver education course. If ignorance is a problem with 401k, well, then education is going to be a solution with that. So we'll just check that box and there you go.
I want to highlight one thing. When you say education, you don't mean education on, oh, you should buy this stock at this time. You're talking
that's
about
advice.
Exactly. I want to clarify the difference there. You're talking about understanding why it's a good or bad offer.
Yeah, if I say go buy Tesla, you didn't learn anything. If I say don't go buy Tesla, you didn't learn anything, right? And so that's key. So let's look at another problem, another solution. Another problem is fees. So what are the dangers? We talked last week about how they can eat up a massive amount of growth and profits over the life of those 401k accounts. And so the first thing is go to your human resource department, right? Go to the personnel department and say, hey, I'm participating in the 401k. I want to know what the numbers are. I want to know what I'm paying in fees. And I want to know, and here's the word you want to write down, I want to know the net expense ratio. And if you can have that and if they don't know, press them. If they don't know, they shouldn't be in the human resource department. But
so Andy, I read on that too. Do you know 90% of the people in human resources who are in charge of the 401ks have never taken a class? They've never studied it themselves. All they do is they've learned what piece of paper you need to fill out.
Yep. Back to problem number 1, no education, right?
Yeah.
And so it doesn't now let me make this, I said this would be very simple. If you go to, you ever seen, remember the old Bob Barker prices, right? I think Drew Carey does it now or somebody. Okay, here we go. Gallon of gas. What's the price?
$2.
Ding, ding, ding. Great. Contestants row. Good job. You're up off contestants row. Movie tickets.
Ooh, $14.
$14. Ding, ding, ding. Popcorn, $35. Okay, whatever, right?
Right.
As you think about the things, you would never go up to the gas pump and say, I'll just fill it up, whatever it is. No, whatever it is. Well, how much is it? I don't know. It could be $1 million, could be $1. More of the movie tickets. In fact, even in healthcare, which has outrageous costs, you get a bill that says, oh, this Tylenol was, $7 or whatever, right? And this is how much the insurance pays, and this is how much you pay. And this is one of those stealthy things that these fees, why in your life would you're putting money in it every week, every paycheck, you're putting, tens of thousands of dollars in here, not asking what the fees are. So it would make sense that if you are going to stick with a 401k and you do want to continue to doesn't it make sense that you would want to know how much the other party's making for managing this and what the costs are, and how much of that is, how much of a bite out of your bum are they going to take, and what that's going to look like in 60 years. Does that make logical sense?
It makes logical sense, but it kind of implies then that once you learn about the fees, you have options. Is that
there
kind of what
are
you're saying?
Yeah, there's different things you can do. There's different mutual funds. Most people give you control over the mix of your funds, unlike the people in Kentucky that had pensions that got in the Daniel Boone Fund, and those fees were outrageous. You can actually look at the different mutual funds that you're in, and you can find out a little bit more information on that. And that's a big deal, because then you get to decide how much or how little you want to participate. Beware of that match. We already talked about the bait, and you have to decide. Again, many people come to me and say, well, after reading your book, Andy, how do I get my money out? Well, you don't jump from the frying pan to the fire, because you're not any smarter than you were before, other than the problem. So understanding, number one, the problem, if the problem is ignorance, then the answer is education. Number two, if the problem is fees, we'll know what they are and find ones that have the lower fees and talk and complain and make people aware.
Is there a ratio that the higher the fee, the higher quality the advice?
Unfortunately, no. As a matter of fact, often it's inverse. Often, for example, we mentioned the pensions in Kentucky. That Daniel Boone Fund underperformed the market terribly. I mean, you would think that over the last 10 years, people would crush it, right? And yet, how much intelligence does it take to buy the S&P 500? Zero.
Right.
And so generally, those that are just following the S&P 500 will have the lowest, they're no-brainer funds because there are no brains to them. So they have the lowest fees. But even if it's 0.5%, why would you pay 0.5% compounded costs over 30 years for something that takes no intelligence to do anyway? So, but the fees need to be watched and need to be monitored, and that would be a first step, is what are the problems, fees? Now, third, okay, so we got ignorance. Education addresses that. You have, I'm getting a little echo back. It just started. Oh, there it fixed. Okay. So you have fees, or you have ignorance, and that's answered by education. You have fees. Well, that's answered by vigilance and selecting, knowing what you're paying for. Now, the third one is something we talk about in the book called systemic risk. And Greg, one of the problems with diversification is people say, well, diversification is a risk management tool. Well, right. Diversification is where they say, well, don't put all your eggs in one basket. So if you bought stock in British Petroleum, I often talk about, and they break a pipe in the Gulf, BP's now broken pipe instead of British Petroleum. And their stock goes from 60 to 30, half your money's gone. So they say, don't put all your eggs in one basket, spread around. But as we saw in the dot-com bubble and the subprime meltdown, and also with COVID, that was a faster recovery. Either way, that's called a systemic problem, where there's a problem that's market-wide. And I will just say, in the most plain language I can think of, is that diversification does not do anything to manage risk in a systemic way. And matter of fact, in that way, someone like Warren Buffett that has isolated great investments will survive a systemic storm better than someone who's diversified. In fact, Warren Buffett said that the answer to ignorance, or the diversification, is simply an answer to ignorance that makes very little sense for those that know what they're doing, unquote. And so if a problem is systemic risk, how do you deal with that? Well, Robert has a book, several out there. And one time he asked me to put a little excerpt in there, and he said, Andy, what is it? What's the difference between amateurs and professionals? And I said, well, part of it is insurance. So if you have a problem of risk, one of the answers can be insurance. Does that make sense? That's a very simple concept. Absolutely. So, here in my home office, maybe my house burns down. That's a risk. So how do I manage the risk of damage by wind or vandalism or theft or fire? That happens with homeowners insurance, right? And whether you own your home outright or have a mortgage, either way, you should have homeowners insurance to address that risk. Well, think about this, Greg. If you go to the census and also the Department of Labor and all the government agencies that get all these statistics, the concentration of wealth, and this is true in the United States and also globally, most people's wealth, the average Joe, is concentrated in their home, and it's concentrated in their retirement funds. Those are the two cash cows. So the mortgage industry licks their chops and they show their fangs trying to get your mortgage, very competitive industry, trying to get you to in hock to those guys. And Wall Street is just insanely aggressive. You saw that President Trump is now pushing for allowing hedge funds to put their fingers in the 401k pot, just like the Daniel Boone Fund with the pensions, right? Just like the Kentucky pension fund. So Wall Street shows their fangs, and it's such a massive amount of money, they can't wait to get their hands on it. Well, how do you manage the risk of that equity in your home? You buy insurance, right? Well, what are people doing to manage the risks in the 401k with all that money? Nothing, not a thing. And
there's nothing they can do, right?
There is things they can do. They're just not doing them. We're going to get to that. But my question before we get into a little bit more detail of that is, which is more likely to burn down in the next 5 years, your home or your 401k?
Oh, your 401k.
For sure, right? Especially when you look at COVID and everything that's going on right now. If people think this little check mark that's happened gets them out of the woods, think again. You had 30 million people miss their mortgage payment last month. Okay. The government, how long can they print and prop that thing up before they do start to have inflation issues? I don't care what Warren Mosler says about deficits don't matter. Hey, if it didn't matter, they'd already print the money and pay off the deficit anyway, or, go in hawk deeper with printing money to cure cancer or figure out AI first. So printing money does have a ramification. I don't care what those MMT guys say. It does, or they do it more. And so how long can that happen? So what I'm saying is there are storm clouds, Greg, in very plain language. There are storm clouds out there that point to difficulties in our economy where the answer is, I don't know, and neither do you and neither does anybody else, or the talking heads on CNBC. They don't know what's going to happen. They're always wrong all the time. And so, it's kind of like saying, Andy, when do you think your house will burn down? I go, well, I don't think it will. Why you buy insurance? In case I'm wrong.
Right.
In case I'm wrong. And so part of risk management is learning about being wrong, that you can be wrong. And so how do you do that? Well, there's a term called hedging. And the term hedging was first used, in fact, Shakespeare used it way back in a couple of his plays. And back in the old days where you had the castles, picture the Camelot type stuff, right?
Right.
And the Knights of the Round Table. Well, how do you protect your stuff around then? You have this massive estate. Well, building a wall around an estate takes money, time, energy, and they break down over generations. A stone wall crumbles, wood fences, decay. And so to create a living wall, a living moat around your castle was a big deal in Europe. And they used hawthorn bushes, and these hawthorns are hedges. They have thorns in them, hence hawthorn. And these would grow 6 meters wide and 6 meters high, and they trim them off square. And these are thick, tough, difficult, dense barriers that are just like a wall. As a matter of fact, when in World War II, when they took the tanks over there and had all that fighting in Europe, they used to put huge spikes and spades on the front of the tanks because the tanks couldn't even get through. They call them rhino tanks. And a regular tank could not get through these hedges. And there were hundreds of miles of them in Europe. So the word hedge means protection. It means to guard against, So I use insurance as a hedge against fire for my home. And notice there are two separate institutions, two separate contracts. The mortgage might be at a bank, or the deed, or I might register, I pay my taxes through the county, right? But then you have an insurance company over here that you're going to pay for your insurance. Well, here's a real interesting thing. There's something called in stock, and you can learn about this, and hence the first thing is education. There's something called delta. And delta, that little triangle, is just what you learned about back in school. It's the change in something, up or down. So when I have when I have a weight issue, I want my, you say, Andy, what do you want your delta to be? Well, my wife would like it to be about 50 pounds to the downside, but Ben and Jerry wants it 50 pounds to the upside. So a delta would be the change in Andy's weight. Does he go up 50 pounds or does he go down 50 pounds? Well, we also have deltas in markets. Is the market going up so many points or down so many points? So think about this. If I were to go to Vegas and I were to bet on black on the roulette table, and then I were to bet on red on the roulette table, and let's say I take the green squares off, what would happen? I take the green off.
You'd win and lose every roll.
Okay, so I'd lose $1 on this roll, but I would make $1 on this roll, which I would be what? Even.
Right.
That makes sense? People say that doesn't make any sense to do. Well, that would be a delta neutral position where I'm just going to batten down the hatches. Well, think about this. I can open up a personal account. This is very important. I can open a personal account with E-Trade or Ameritrade or Interactive Brokers or Schwab or whoever that is separate and unknown to my company. Just like my checking account is separate and unknown to my company, just like a savings account or an IRA or things that none of my company's freaking business. None of those 401k guys' business. Do you see that separation?
Yeah, so you're saying your company has the 401k that you're feeding to.
Yeah, and they know my balance, and they know what's going. They send me a statement, and they take the money and send it to them. But I also can have a private account.
Okay.
One of the things I can do is I can create trades with options. If I learn the options market, that if all of a sudden COVID hits and it's really nasty, for small amounts of money relative to the size of my account, I can create a delta neutral position. Just as if I was betting on black and red. And now if the market goes up, great, my 401k makes money and I lose my insurance money, just like my house. Think about it. My house, I'm paying a little bit for insurance, but if my house value goes up 10% or 6%, that more than covers the cost of my insurance, correct?
Absolutely.
But if my house burns down, what does the value of that insurance contract do? It explodes in value, right?
Right.
And it covers the cost. So I can create more of this delta neutral position if I know how to deal with options in my own personal account.
So a little bit of a challenge here. Because the fees are so great, up to 80%, you really have to get your insurance, your options, at a pretty minimal price, because you're protecting not just your money you're going to end up with, but also there's horrible mutual fund people. Is that
well,
accurate?
yeah, I mean, the fees are a different, separate issue. You're going to look at the balance you have. They're going to pull theirs out every year, so there's nothing you can do. I mean, they're going to take their money, right? But as far as your share of it, right, what you're getting there, what you see on your balance, absolutely, you can hedge against that, and your company would never even know it. They would never even know it. So that's one thing you can do. Another thing you can do is, again, go in and get educated on the rules of your 401k. Now, there are some 401ks that only allow you to move your money around once a quarter. Usually there's a list of maybe 16, 17 funds to choose from, aggressive down to money markets, bond funds, everywhere in between. If you don't know or just say, oh, I'll just go with that, they'll put you in some type of a 60-40 mix or an age-adjusted program based on your age. But if you really care about it, you can actually do some direction, many places in your 401k. So you know what? Things are kind of scary right now. I still want my employer match, but I think I'd rather be in bond funds. They don't pay as much. Or maybe I'd like to be in a money market fund. And where that comes into is our 4 pillars of investing. How do you know when to move stuff around? It's very much like me with stocks. How do I decide if I want to stick with one and get the dividend and build a great cost basis? Or what if I say, I think I want to move on and do something different? I use my 4 pillars. So I have thousands and thousands of stocks and options to choose from. Well, 401k might have 10 to 20 choices is all, but their choices are there, and you can move those around a little bit. So maybe someone says, gee, things are kind of scary right now. I think I'd like just to go to cash. Most people don't, 401k don't even know they can do that. It's just someone else's problem.
Yeah,
so find out.
That?
Yes.
You can go to cash.
Yeah, most of them have like a money market fund, which is basically a type of savings account.
Oh,
and so you say, I think I'll go to cash for a moment, right? I think I'll do that. They need to understand when and what. So there's hedging you can do. There's moving around and reallocation you can do. But both of those things require what?
Education.
They do. If you don't know how to hedge, you don't know how options work. One of the things that Marcy and I did that was a real lesson for us is when we were first married in the 90s, she worked for a company that made wire. They're out of Georgia or out of, the state of Georgia. They had a plant here in my home state. And she started out as their receptionist and worked her way up through management where she was running half of they had copper and they had aluminum, and she ran their whole copper side division. And they all had 401ks. And we were just kind of in that rich dad, poor dad mode where we were just learning about it. And I was in sales and I was approached by a group to say, Andy, sell our software. You're a good salesman. Sell our software. It's trading software. I go, I don't know anything about trading. And I didn't back then. And I remember I took a course on fundamental analysis, and we learned what a moving average was. And I looked at the moving average over long term, and I saw that when the stocks were above the moving average, if I was in, I'd have made money. And when stocks fell below that moving average, that's when you would lose money, right? It just trend. And I didn't understand it very well then like I do now. I looked at it incorrectly as more of a predictor. And you can get whipsawed, and there's some problems. But what we did is we said, you know what? If it's above the moving average, let's be in equities. And if it's below the moving average, let's go to cash. And in that year 2000, when we were doing this in the 90s, and when that market came to pieces, I had some money that I'd lost, but my wife, it started going down, and we pull it out when that moving average fell, when the average prices of those funds fell below the moving average, we just went to cash. And it saved my wife. And so when the dot-com bust happened, she'd go to the water cooler and all these guys are getting their butts kicked. And she was in cash. And we barely knew what we were doing. But we did know a little bit. And it worked out. Worked out for her. And it wasn't a lot of money she had. She worked there maybe 10 years. So it wasn't a huge amount of money, but it was significant enough to watch and to care about.
It's enough you don't want to lose it.
So you can have some ability to allocate. Okay. Robert was very kind, and he was kind to write the foreword for my book, 401 Chaos. And it's one of the best parts of the book, actually, is his one-page foreword. And he says, look, I didn't need a 401k. I don't invest in 401k because I don't need one. I have real estate that pays me. I have business that pays me. Why would I pay these fees? Why do I mess with all this stuff? I have other sources. But if someone is stuck in their job for the short term and they're addicted to that paycheck for the time being, well, first make a commitment to get out of that someday. Maybe today's not that day. I get it. Maybe today's not that day. But start investing other places and learning other places. And that brings me to another flaw in the 401k. So let's review what we've talked about. Number one is the ignorance problem. What's the solution? Start learning, for crying out loud, right? If you want.
And it doesn't have to be difficult or expensive. You can learn from books. I think
you could. That's a great place to start to figure out what you want to go. Then if you want to read a book, if you're interested, go next level, take a course, right? Get a mentor, stuff like that.
Right.
So you have ignorance is a problem, education is a solution. You have fees as a problem, well, find ones with lower fees is a solution, right? Or work to get out. The next thing you have is managing it, the managing of that big systemic risk. Well, two things you can do. Number one, you can learn to hedge. You can create a separate account, learn to hedge, learn how to buy insurance, if I might say, opposing investments, that if this one goes down, this one goes up, right? If this one goes up, well, you'll lose a little insurance over here, but you will not, you won't, you'll sleep better at night, right?
Right.
Think of what I said about my home, right? I have insurance on my home in case of fire. Okay. The next is reallocation. You don't have the market is not your world in a 401k. You're going to be stuck in these mutual funds, but they do rank them. Learn about them. International growth might be one. Large cap, small cap, mid cap. Learn what those terms mean and why that is significant, right? Blended funds, bond funds, funds that go up based on your age, where the mix of equities to debt shifts over time, right? And then find out which ones are like money market funds where you can just be going very conservative in cash. And you can learn about the varieties of reward and risk to those and learn about asset allocation. And there might be times where in COVID, say, you know what, I might feel more comfortable in having a little bit more of my money in a money market right now. Or maybe you look at the printing of the money and say, oh, no, I want to be in debt right now or somewhere else, right? Important stuff. That leads us to another thing, and I don't want to make these too long because you know me, I could talk all day, and we tend to go too long. So I'll shorten it up a little bit. But there's some other things to think about. Before we go on, any questions you want to ask on what we've talked about so far?
So I just want to acknowledge that this whole money market thing, I'd never heard that before. I had no idea. And it almost seems like while you're getting educated, while you're trying to figure this out, that may be one of the first things you look at is when to put your money in the money market and when to pull it out. Like that might be just the first thing you should learn.
That's 4 pillar stuff, and you need to know what your mix is and how often you can go in there, because some will allow you to do it once a week. My wife only allowed it to be done, I think, every 2 weeks. Some are once a month. Some are once a quarter, which is, kind of nutty, right. That you can only move stuff around once a quarter. But find out what your plan is because they're all different.
So that's fascinating. I had no idea you could go in and change your setup. And I also didn't know you could get a separate private account and do options. Like that's a big deal. Those are 2 key solutions right there.
Another thing you're allowed to do is, I mentioned Robert said the reason he doesn't have a 401k is because he doesn't need one. And I was speaking with a friend of mine who's a financial advisor, and all he does all day long is have people that are 60 years old come in with $500,000 high, what he would consider high end. It's not even close. That's way above average. But they don't have enough money to retire on and they didn't know it. Like, you mean I can't live on $500,000 from 65 to 85? I go, well, do the math. No, you can't.
Right.
And so he sees this, he sees this problem all the time. And I told him, I said, what if someone came and they had a stock portfolio that paid some dividends in addition? You see, one of the next problems we need to talk about, this is very important, is that one of the problems with the 401k, we talked about this last week with like Richard Stanger and Ted Benn and all these guys that put it together, is that the 401k, listen carefully, was never, ever, ever designed to shoulder the burden of retirement. So if the problem is it's not designed to shoulder the burden of retirement, well, then the solution would be don't expect it to.
Right.
Right? Don't expect it to. So if you feel like if you're taking that bait and they've reeled you in on the employee match thing and you're, addicted to the paycheck, start weaning yourself off that and say, you know what? I'm going to buy some stock over here in this account because that bypasses Wall Street. I can go open up an Ameritrade account right now and trade stock for free because they just want the assets under management, right?
Right.
But I'll tell you what, commission free, once I own that stock, now I get those dividends from the company. It's not Wall Street. Understand, when you buy stock in Apple, you are a partner with Warren Buffett, who's got about 40% of his money in Apple right now. Talk about not diversifying. And the way Warren Buffett talks about it, he says, look, I just see Apple as 40% of our business. He doesn't look at it as a stock. He says, yeah, it's 40% of the business of Berkshire Hathaway's business. 40% of what we do is in Apple right now. Great.
Gotcha.
And so he bypasses Wall Street, which is the advice and the fees and the mutual funds and all that crap, by owning a company. Second thing, I don't own a lot of real estate, Greg, but we've got some syndications that we're involved in. We've got some properties out of state, and we've got some rental houses here in my home state that we have. And I went to that financial advisor. I said, what if you just had, and I kind of showed him some of the stuff I had. I said, look at the precious metals that we have. And I says, look at the real estate that we have. Not nearly, like I'm not even in Kenny McElroy's universe, right? Or even Robert Kiyosaki's in real estate. But, even if a guy had, 4 or 5 properties or one, I remember I can't remember the infomercial on real estate in a long time, but this guy was saying, come take this course on real estate. And he ended it with something powerful. He said, what if all you ever did is buy one more house? Right. And I look at my folks or my in-laws or whoever, and I thought, what if you just bought one more house, let the renters pay it off? What that would mean to you in retirement? You bought one, don't you think you'd buy 2? I plan on buying more I'm a stock guy, but I'm going to buy more rental houses. I'm going to buy more stocks. I'm going to start more businesses and start having money put. If the problem is that it wasn't designed to shoulder the burden of retirement, don't treat it like it should shoulder the burden of retirement. Start getting other stuff going.
Right. And that's also the Robert Kiyosaki solution. He says diversification works if it's diversification amongst different asset
classes. Yeah. I agree.
Which is what you're talking about. Some stocks, some business, some commodities.
And even then, Kenny's not diversified. He's just really, really good at what he does. Sure. He's really, 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 really good at real estate. I mean, I've never seen that guy screw up. He probably has and hasn't told me about it, but I've never seen it myself. I'm sure I've lost a lot more money in stocks than you've ever lost in real estate. But I will tell you that the 401k thing, don't go from the frying pan into the fire. That doesn't make any sense. And I guess if you're in it, that's better than saving nothing, because if you turn 65, at least a couple might have $100,000, where before they might have had none. That's a rough thing. But I would just, again, advocate with that first thing. The more you learn about it, the smarter decisions you will make. Isn't that just like way simple? Stop getting caught in the advice trap of asking people what you should do, because you'll never get anywhere with that, because everyone's going to have a different opinion. And it's usually they're going to say, well, give me your money, right?
Right.
Get out of that advice thing and start learning. Because
that's why I started with, you cannot outsource these decisions. These have to be your decisions. And if you're going to make them, you have to get educated.
That's a good way to wrap this show, because the reality of it is nobody cares about my sons the way I do. And there might be some daycare for assistance needed, but if I drop my kid off at daycare when he's 3 years old, and then I show up to pick him up when he's 21, I might not be happy with how that kid turned out, right? I might not be happy. So a little supplemental, yeah, I understand that, little daycare, but there's no substitute for mom and dad. There just isn't. There's no substitute for mom and dad. The village can't raise, it takes a village to raise a kid. Well, it takes a mom and dad too. Right. And so with your money, I will just tell you, there's no one on this earth that cares more about your money than you. And if you don't care about it, they'll take it from you. So that's a good way to wrap it. So hopefully those are some great solutions. Number one, problem education or problem ignorance solution education. Number two, fees, eat it up, find out what they are, go with ones that have less fees, right? For sure. The systemic risk problem, get an account of your own that can hedge that, right? Also, you can reallocate, but that requires education as well, right?
Every one of your solutions required education.
Well, that's why I'm in the education business. There is not an asset class that people are more involved in that they know less about. There isn't. There is not an asset class with wider involvement and less knowledge than this one. So, you'll forgive me. I won't apologize for being passionate, but you'll forgive me if I am, because it hurts people. And we saw those numbers last week where this is getting people. So learn it.
Absolutely.
Learn.
And I just want to point out one more thing, and then we're going to go. The answer was not get out of 401k. The answer was education. It's not take drastic action before you get educated. You have to get educated before you do anything. Yeah,
it's not. That's the advice problem is people say, what do I do? Do I get out? Tell me what to do. I'll just get out. That's frying pan into the fire. Either way, you're going to get cooked.
Yep. Well, okay, Andy, thank you so much. Yeah.
I love these weekly meetings, man.
This was my favorite one, because those really are solutions that people really can do. Yeah. And none of those solutions were outrageous.
Hopefully not. I don't have a 401k. That's my solution. I don't want one. I don't think I'm going to need one, and I don't have a job. No one who would hire me. So I don't have a job. But that's kind of weird. It's a different context, isn't it?
It really is.
Yeah. So there you go.
All right, Andy. Thank you so much. I can't wait to talk to you next week.
Thanks, Greg. Great to be with you.
You too, man. Bye.